In recent years, public limited companies have paid out over £1 trillion in dividends to shareholders. But what exactly is a public limited company? In this video, we are going to explore everything there is to know about what public limited companies are, including the advantages of operating as one and the disadvantages associated with registering as a public limited company. Let's revisit Jaden and Louise's burger restaurant business from our previous video on private limited companies, which if you haven't already watched, make sure you go and check it out. The burger restaurant has seen significant success over the last 10 years, opening over 100 locations across the UK. However, they plan to expand their business into new geographical markets, such as America, the rest of Europe, and several locations across Asia. Now, despite their success, funding this massive expansion plan is a challenge. However, they discovered the concept of taking their private limited company public, also known as a stock market flotation or an initial public offering. So, a public limited company is an incorporated business structure in which a company is a separate legal entity from its owners and is traded on the public stock exchange. The public stock exchange is a regulated marketplace where shares of a public limited company can be bought and sold by the general public. In the UK, we have the London Stock Exchange. In America, they have the New York Stock Exchange, among many others. Now, being a shareholder of a public limited company gives you the voting rights at the annual general meeting, where you can elect the company's board of directors, who will make the important strategic decisions and oversee the running of the business. However, if you only own one share, your influence may not be that significant, because some public limited companies had tens of millions of shares issued. Some of the biggest brands in the world that you love and know, such as Google, Meta, Apple, Amazon and McDonald's, are all public limited companies. And a quick tip, in your exams you can identify a public limited company as it will be abbreviated as a PLC. Now, for Jaden and Louise's burger restaurant to go public, they need to ensure they have a few things in place. Firstly, they need at least £50,000 in share capital, 2 company directors and 1 company secretary. So becoming public isn't actually a straightforward and easy process. Normally this process can take months, even over a year, to get everything planned and in place. Now, before we take a look at the negative aspects of shareholder pressure that public limited companies often face, let's first of all consider the benefits. For Jaden and Louise, who have ambitious expansion plans, raising a significant amount of capital is crucial. They need enough money to open hundreds of locations, hiring staff, establishing their supply chain, and so much more. This is one of the primary advantages of operating as a public limited company, because listing on the public stock exchange opens up the business to tens of thousands of new investors willing to invest their hard-earned money into their venture. Therefore, Jaden and Louise can secure the funds needed to open up new burger locations across the world. Now, for investors considering buying shares, they are also protected by limited liability, meaning if the business does go bankrupt, their personal assets, such as their homes and their cars, are protected. Also, despite Jaden and Louise's popularity within the UK, they're relatively unknown in the new markets they plan to enter. However, being a public limited company often leads to greater exposure, such as media outlets reporting on your business, enhancing your reputation and prestige. This visibility can enable businesses to negotiate better deals with banks for borrowing funds and improve their terms with suppliers. But we're going to delve into the downside of this visibility shortly. However, becoming a public limited company can present some significant downsides for Jaden and Louise's burger restaurant. Firstly, by selling their shares publicly on the stock exchange, yes, they do raise substantial amounts of finance through share capital. However, this also means giving away large portions of their businesses to shareholders. With many new shareholders, there also comes considerable amounts of pressure on the business owners to achieve one main goal: generating substantial amounts of profit. Remember, shareholders earn money in 2 different ways. Firstly, dividends, which are a share of the company's profits, and capital gains, which occur when the value of their shares or the share price increases and they go on to sell this. This can lead to a push for profit maximization from the shareholders, potentially conflicting with the company's broader objectives. Additionally, share prices are extremely volatile, changing every second of the day, affecting all public limited companies. Also, Jaden and Louise's burger restaurant business will now face increased levels of public scrutiny as news and media coverage begins to intensify. Any missteps could become headline news in the local papers or on national TV. Therefore, getting public relations and corporate social responsibility right is so important for their businesses. Finally, inviting the general public to invest in your business entails a whole host of legal requirements and regulations. Investors are entrusting their hard-earned money to you. So for Jaden and Louise, this means filing annual accounts that provide an in-depth insight to their business's finances and strategies, so investors are well informed. This does take though additional work, consuming both time and resources. I hope this video has helped you understand what public limited companies are. Feel free to check out more of our videos on our channel.